Hi and welcome to Westpac Economics end of day from London for Friday, July the 29th. Look, one big story in town, it was the US GDP figures. Not only were the second quarter numbers weaker than the market had expected, with growth slowing, so with growth reported at 1.3% annualised, very close to our 1.2% forecast, but there were substantial downward revisions to history. The figures are revised once a year, annual benchmarking revisions. This time around, those revisions made the recession of 2008-2009 deeper, and the recovery since the recession has been revised to quite a bit weaker. And in fact, every quarter last year, 2010, was revised down by a progressively steeper amount, such that by the end of the year, what was previously recorded as a 3.1% GDP growth annualised has now been revised down to just 2.3%. And in the first quarter of this year, the economy almost stalled, annualised growth of just 0.4%. Which means that in the quarter, growth probably only grew around 0.1%. So a very weak first quarter now. Now that means that the second quarter numbers, which is the latest information, the new stuff in today's report, actually represents a bit of an acceleration from that weaker starting point in the first quarter, although it was certainly softer, as I say, than the market had been expecting. What was particularly disappointing was that spending on services by consumers was just 0.9% annualised in both the first quarter and the second quarter, which is a real sign that the consumer in the US is just not spending like he traditionally has done during economic recoveries. It just goes to prove that what we've been saying at Westpac for a long time now, that you don't get a typical recovery after a recession in the US if the housing market is not participating in it. And the housing market certainly has not. It's, apart from some support last year, which helped it temporarily in 2010 and late 2009, the housing market looks like it's showing renewed weakness again. That means people are uninclined to spend, they're worried about the house prices, they're worried about their debt levels, and of course we've got the added complications related to shortages of parts from Japan, and now the debt ceiling issue, which continues to worry markets and more intensely, of course, the closer we get to the August 2nd deadline, just a few days away, early next week, Tuesday. So and on that, there has been some ebbing and flowing today in terms of how sentiment is sort of perceiving likely developments, with at one stage a plan by Boner, his plan looks like it might be getting a little bit more support, but as I speak, markets are now starting to worry a little bit more again. So no real movement there, I'm afraid. So they're the main sort of stories today. There was plenty of other economic data. Cost index in the US was higher in the second quarter than expected. The regional surveys in Chicago and Milwaukee were a bit softer. Consumer confidence published by the University of Michigan was revised down a little bit. All pretty minor stuff though compared to the shockingly bad news on US economic growth. If the Fed had forecasts of economic growth as weak as the numbers that are actually printed today, if they had those forecasts a year ago, QE2 would have probably have started earlier and been significantly bigger than the 600 billion worth of asset purchases that we had. There were some European numbers as well, weaker than expected flash inflation for July. Our view is that the European Central Bank probably won't tighten interest rates further. We got a little bit of support from that view. German retail sales numbers, however, were very strong, the biggest ever rise, something like 6.7% in the month, just going to show that those figures are really rubbish, not worth watching. They changed the sample survey size, changed the sample composition, pushed out 33% of firms, put in 33 new retailers, and that probably distorted the numbers substantially. In the UK, we had some soft numbers on consumer confidence as well. That's the roundup of economic data. A quick roundup of the markets for you. Stock market's still trading. It's only just 4:30 in the UK at the moment. European markets heading into the close. Average loss there about 0.7%. With negatives right across the continent. At one stage, though, the losses were approaching 1.5% or more, mainly because of the weak economic data out of the US. Speaking of the US, we've got at the moment a loss of 0.2%, but look, it was down more than 1% at the open, rallied 150 points back to basically where it yesterday's close. Now it seems to be losing some ground again as markets ebb and flow in terms of how they perceive the debt ceiling issue going along. On the commodity markets, oil is down, but not down as much as it was. It's currently pricing at $96.18 a barrel, which is still down 1.3%, but it did have a steeper loss when those weak GDP numbers came out. And gold is up 2/3%, at $1,627 an ounce. Aussie dollar rose from 1.09 at the start of our session to around 110, up about a cent on the week numbers out of the US on GDP. And that's about it really. US dollar a bit softer again today. No surprise there. Next week, a couple of things to watch for. It's the RBA decision. We're not expecting any change in interest rates there. ECB and Bank of England, no change in rates expected in either of those jurisdictions. And we've got the monthly payrolls numbers or employment numbers for the US on Friday. We're looking for a week-ish 70,000 increase, and we feel increasingly confident that our view on that is right, particularly given the weak economic numbers that we saw today on growth. Okay, that's it for me for today. I'll speak to you again next week.